Afternoon, everyone. Welcome to the Green Lantern Capital's webinar. We have with us the key management team of Green Lantern Capital Portfolio Management Services, Mr. Nilesh Doshi, our CEO and Managing Partner, and Mr. Abhishek Bharadwaj, our Senior Fund Manager and Managing Partner with us. And Mr. Pradeep Gokhale is also here with us. He is our Fund Manager. We are going to cover various aspects of market, including our view on budget, market, uh, quarterly earnings of corporates, and various other things. And after that, we'll follow it up with the question and answer. So with that, I'll hand over to Mr. Nilesh Doshi. Sir, over to you, please.
Yeah, guys, thank you all for joining us on the call. Since the result season is going on and most of the results are out, so as usual, we normally hold this webinar every quarterly to share our views on largely on the market and surrounded with what's happening on the macroeconomic front, global geopolitical front, etc. So before I hand over to Abhishek, I'll just recap our performance. On last 1 month, we are -4%. And on 6 months basis, we are -9%. So we are on a benchmark parity basis, we are, I mean, more or less similar with respect to BSE 500. And on 5-year basis, we still continue to perform at 47% CAGR return. The typical question we get nowadays is that so far we have been able to protect and better navigate the market. The portfolios across we are seeing with people is down substantially. And at the same time, the Nifty is around 12 to 15% in that range. So the question we keep getting is that so far you have been able to manage, but what now? And when the market goes down on 1 day, everybody feels happy. And if it goes up like today, the question arises that is it not time to deploy? And what is our actual view? Why are we not deploying, etc. So we thought that it's better that we cover all these aspects in this current talk. And more detail we will take up on the Q&A basis. We will not be talking on the stocks specific, but overall observation on the result side vis-a-vis the valuation side, I think we will cover in this discussion. So with this background, I'll hand over to Abhishek. He will take us through the entire discussion.
Just quickly cover some of these points, and I think we'll leave more time for Q&A. I think there'll be a lot of questions because there's been a lot of volatility in the market, and I'm sure investors have a lot of questions regarding how we plan to further build the portfolio and how do we look at the market. So I'll just quickly cover some of these things. I think you would have read enough about Union Budget, so we'll not spend much time. In terms of our view, how we look at it, I think we are happy that government has maintained fiscal discipline and is continuing to maintain that 4.5% GDP fiscal deficit target. So that's a good thing. I think the focus has been a lot on skill building, manufacturing, again, all good focus. The fact that consumption was weak on the domestic side and government has taken recognition of that, is recognizing that, and has cut interest rates, is leaving more money in the hands of individuals, is again a good thing. We are of a firm belief that individuals will do better with their money than government. So to that extent, it's a good thing. I think what needs to be seen in this budget is a couple of things where, so all is good. A couple of things that one needs to keep in mind. One is, for the first time in last 2-3 years, the revenue target for the government looks a little bit on the aggressive side because they've already cut interest already cut tax rate, personal tax rates, and despite that, they are assuming 13% kind of 14% kind of growth in personal tax collections, which on a lower base because they have already foregone around 1 lakh crores of income tax leads to around 22-23% kind of growth, which looks extremely difficult even with higher compliance, looks very difficult. So there can be some miss on the fiscal deficit, which if government wants to maintain the number of 4.4 can lead to further drop in spending, mostly from capital expenditure, but could be from the revenue side as well. So that's one thing that one needs to keep in mind. Even assuming all these numbers are there, government spending as a percentage of GDP continues to come off from 15% in FY24 to around 14.2% targeted for the current budget. So again, the spending from government will be lower. This includes both capital as well as revenue expenditure spending. So that's also something that will prop up the GDP a little lesser. So these two things. Other than that, I think we like everything that's been done in the budget, and of course, this was a well-needed step from the government. This personal income tax rate cuts. So that's where we are on the budget size. As far as the earnings are concerned, so for the quarter and for 9 months. So a lot of companies have already declared their results, but not all of them. So far, what we have seen is that revenue growth as well as profit growth so far has been weak. From 22 from 20 to 24, we saw almost 18 to 20% CAGR in earnings growth, while for 9 months of current financial year, we are seeing around 4 to 5% earnings growth, which is, of course, a concern on the back of the fact that over last 3-4 years, we have seen markets run up a lot. We have seen valuations pricing in much higher growth rates. So this drop in growth rate is something that markets are concerned about, and one of the reasons why we are seeing a lot of FII selling, and in general weakness in the market. Uh, uh, from a sectoral perspective, I think few sectors have declared reasonable results, banks, pharma, real estate, cap goods. But then there have been sectors and segments which have disappointed, like cement, metals, even auto have so far disappointed. So overall, mixed kind of result, but yes, weaker from what we have been seeing over last 3-4 years, both on the top line as well as on the bottom line front. The third part that we just wanted to quickly cover was what is happening on the global front and how basically that will. So I'll just touch upon, and then maybe in the Q&A we'll discuss more on this. So what we are seeing now, earlier there was this war which was happening, and Ukraine-Russia war or Israel war in Palestine, etc. And now what we are seeing is the increase in trade war. And while market had absorbed the actual wars, the trade war is something that is creating another level of uncertainty. This is inflationary, more inflationary than the actual war, because it will increase inflation in United States, US, which is the largest market and largest capital market of the world. So what we are seeing is that cost of capital for the world will go up, risk premiums will go up. At a time when the world is slowing down, earnings in India is also slowing down, and cost of capital and risk premiums are also going up. So what this essentially means is your PE multiples, which had increased over last 3-4 years, uh, will compress, not just because of lower growth rate, but also because of higher cost of capital and increase in uncertainty. Uncertainty means that for deploying your risk capital, you would ask for higher compensation, higher risk premiums, which essentially means that we will be, as investors, we'll be willing to pay a lower multiple. So broadly, that's where we are. On the geopolitical front, we can discuss. So this will be an uncertain environment where in last few days we have seen how the US administration has imposed taxes on Mexico, Canada, and then decided to withdraw. There could be taxes on Europe. We could see more Indian companies, Indian businesses also getting impacted over next 6 months to 1 year because of these policies. And that's where we believe that there will be a lot of uncertainty around this on the geopolitical front. Uh, and then it's on the valuation. Maybe I'll ask Nilesh Bhai to kind of sum it up and take through the valuation and overall market view from here on.
Yeah, can you hear me? Thanks, Abhishek. I think I just add more on the geopolitical side to this is that the trade war post-Trump was definitely anticipated. And we have seen that in the Trump one era also 4 years ago. So the impact of trade war we have seen in 2018 cycle also, and now uh, we, I mean, this is the second run of Trump, and probably we all know that his election campaign was also centered around manufacturing in US and trade war. I mean, basically, what we all the time observe from Trump is that he's constantly bent upon the trade deficit with other countries. His belief all the time is that the other countries are exporting to US and making money and not buying American goods. At the same time, the theory with which he believes that there should be manufacturing coming back to US, and then US companies should be able to export, and other countries have to accept those exports in a very free, I mean, fair manner. So with all this, we have seen the moment he has taken the position. In last 1 week, we have seen he's signing executive orders as well as he's making announcements of variety of taxes or basically entry tax to most of these. The important over here is that if this trade war I mean, takes a very severe step, probably in last 2 days, what we have seen, and we all of you, I mean, all of us know that Mexico and Canada immediately, uh, I mean, would have approached and said, let's discuss, and we are ready to support or we are ready to comply with whatever is required. And then we saw a flip-flop. Uh, Similar things may happen with Europe and India also, and even we may align on those lines to work jointly and together so that this kind of impact is minimized to our businesses. But on the other side, what we have seen from China point of view is that they have put only 10% tariff on China, and China is trying, rather than negotiation, China is probably trying to retaliate in small manner. So if this bilateral trade war continues, plus if we observe Trump supporting or I mean domestic industries and incentivize putting up manufacturing facilities in US, this could be an additional impact on the global capex cycle. Because if there are capital building process happening in India, China, or other parts of the world to cater to the largest economy, that's US, uh, that probably can, every boardroom will start rediscussing whether we should expand or put up new capacities and look upon exports to the strongest economy even today is US. So that could be one area which needs to be observed because suddenly we will see capex maybe getting postponed or getting delayed or coming on hold. Second is this also will lead to overcapacity in other countries. Like if there is a tariff war on China and there is an overcapacity in China, Chinese companies will try and dump these products in other markets. And other markets will also have to resort to self protecting their own interest and may again come back with anti-dumping duty or some kind of tariff on the importation of goods which is coming or being dumped from all these economies. All this can result into higher inflation even in US. But interestingly, what happens is that this can also have an impact into the currency adjustment and currency war. So, which we also have to keep in mind that if this currency war is an output of the trade war, if this continues or it happens, then all this will have an impact on our global equity market. So what we have seen is probably Trump coming in and in anticipation of trade war happening, we have seen global currencies weakening against US dollar. We have also seen capital outflow from India. I mean, all of us know that FIIs have been selling since October. And we have seen the capital outflow from India, where our currency is, although our currency is less weakened compared to the other currencies, but yes, it's the directionally we are seeing our currency is also weakening. So summarizing this, that ultimately no one knows what's going to happen, whether this trade war will stop. But what is clear that this will create a lot of uncertainty in the minds of entrepreneurs and in the minds of investors. And therefore, to navigate this kind of uncertainty is a very, very challenging task. One day we see the stocks get, for some such narrative, stocks get hammered by 10%, and next day, if there is a flip flop, the stocks go up by 10%. Now, investment hypothesis or investment can never be done on the basis of these kind of volatile movement. For investment, it needs a very clear and structural thinking that the stocks where you want to invest or the economy where you are residing is doing good. There is going to be an earnings, clear visibility of revenue and earnings growth. And at the same time, the stock should be available at extremely favorable risk reward ratio. Typical pattern, what we have seen from questions we get from investors call or investors keep asking is that since market has fallen, the stocks have come up by 30% or 40%. Is it not the time to buy those stocks? Theoretically, everybody feels that yes, when it comes down by 40% from the peak, it's very attractive. But as fund manager, when we have to look as an investment, it's very critical to understand that whichever stock where you want to invest, is the revenue growth what we have seen in last 3 years is going to continue? A, what are the factors which can impact those revenue growth? B, whether even if there is revenue, there is some revenue growth, not what we have seen between 22 to 23 or 24. There is a lower growth, whether the margins are going to remain. You have seen couple of results today. Even I saw a couple of results where the companies were growing at some 20%, 25%, and suddenly this quarter the numbers are YOY growth of 7-8%, and margins have declined by 4 percentage point. Now, this kind of sudden change in the outlook of the business. Then the next question arises for fund managers is that at what valuation we are. Number two, is this revenue growth, even if let's say we bring it down in your financial modeling by from 12% or 15% to 6%. And even if we prune the margins to the new margin which has come in this quarter, then the question arises that if your the economic growth which you are expecting or anticipating. Now, if the our own economic expectation of growth is 6.2% to 6.8% next year, and with inflation, if we are now talking of 9.9% kind of a nominal GDP growth versus what we have seen 13-14% nominal growth 2 years ago, or even 15%. Uh, with the lower growth coming, whether should we give those businesses the valuations which they have enjoyed in last 2 years? So when we look at all this analysis, the question does arise that whether we should buy even if the stock has fallen 40%. Whether this stock, which has fallen from, let's say, 130 multiple at the peak, with the best of the result, today it's at 80 multiple, and the stock is down 30%, should we buy? Whether this 80 multiple, when we do forward analysis of earnings next year, with so much complexity around, so much uncertainty around, no one knows what's going to happen suddenly in terms of capital goods, capex, order book, etc. Whether this PE, what looks today 80, will look 120 forward looking because of any revision, downward revision in the earnings, or it will look 40 multiple going forward. So, in a scenario like this, it's very important for investors to understand that we are in a very slow declining GDP growth rate, and therefore, whenever there is a very slow, reduction in the GDP, even the earnings collapse, we are not seeing to that extent. As Abhishek explained, it's a very mixed bag of earnings, and though directionally it is weak, and the weak is more on the especially on the growth rate side, and also on the margin front side. Margin expansion is not happening. Now, in a scenario like this, what typically needs is that you have to have a very clear visibility of the revenue, earnings growth, and extremely favorable risk reward ratio. And that is to us appears very challenging because we are very slow grinding on the downside as the economic front. As Abhishek explained that in our budget, our expenditure on the infrastructure side is also more or less capped at what has been last year. What we are similarly observing is that there is some limitation in implementation side also. And uh, finally, we have seen in this quarter numbers that a lot of businesses which were taken at 80 multiple EPC businesses where their margins have suddenly started cooling off. So, net, how do you navigate? Of course, there is a lot of anxiety among investors that we should deploy immediately. Why are we not deploying? But what we find is that in a very slow scenario, whatever you tend to invest in a hurried manner will probably give you a pain because markets are not doesn't look like uh, giving you, especially on this mid cap side or large mid cap sides, we don't see markets are going to reward that soon. And also, net market is also going to be a bit narrow as we see in terms of revenue and earnings growth. So our way of thinking is that still it is not an extremely favorable risk reward ratio that we come on front foot and start investing. But we are getting some opportunities which we are seeing slowly, and we will start deploying over next couple of months in some of these stocks. However, the overall opportunity in the market is going to be very narrow, and we will see most of the stocks very high chance that they will keep grinding down slow and steadily. So this is one strategy which we believe will probably will have to adopt. Number two, with this uncertainty, global uncertainty, and uh, the capital good impacted because of the, infra spend and on the and uh, on the economic front, what we have seen Probably we will have to look at the domestic sectors uh, uh, for some kind of a reward next year, maybe at an appropriate time. But we'll have to look at domestic businesses which are independent of this trade war and which can self-sustain depending on maybe let's say good monsoon or consumption or with this kind of tax benefit, the capital, I mean, those kind of spending may happen on some durables or leisure travel or etc. So we will have to focus more on the domestic side. And thirdly, banking is an area where the valuations are not very high. So one needs to see if we get some kind of opportunity over there. So with this, I think I'll pause over here and then we can move towards question answer. Thank you.
Yeah, sorry,
We have
just
a
a point.
question.
Nitin, just I just wanted to add one point that whatever we are discussing now is based on the situation. So it's a very, very dynamic situation that we are dealing with. And most of the things that we talk about here are in the context of what we are seeing currently. So I'll just to give you an example. One of the reasons why we have tight liquidity in the domestic market is also because of the strength of dollar. And for all the geopolitical situation which is happening, we expect that dollar may continue to remain strong and it will continue to put pressure on Indian rupee. And consequently, because our central bank is trying to support rupee, so it is selling a dollar and it is buying rupee, which is sucking out liquidity from the domestic market. If something like this reverses, if we see change in the Trump policy, overall environment becomes a bit more benign, we may witness the dollar cooling off. If that happens, the pressure on rupee also goes down, and consequently, liquidity situation in the domestic market will improve, which may mean that credit growth, which had come off from 16, 17% to 11%, the outlook for that also changes, deposit growth changes. So, what I'm trying to point out is if we have reasons to believe, and if we see that some of the factors that are making us cautious change, we reserve the right to change our view. It's a dynamic situation, something that we are constantly watching. We are looking at almost all the factors, going through all the businesses, whatever is happening with companies, looking at opportunities in this uncertain environment as well, where we believe that there could be a lot of opportunities for domestic manufacturing, where we are doing import substitution because we too are adopting and will continue to adopt a, a policy where we are trying to protect domestic businesses to reduce our import dependence. So, so all of these things do remain. So while we remain cautious in the context of where valuations are and where growth is, but if some of these factors change, we reserve the right to change our view. Yeah.
So we'll take Q&A. There's one very interesting question I'll read out is says that if we say trade war, then it may keep interest rates high. So due to this, there will be inflation. And can it create recessionary or high interest rate environment for next few years across the world? And equities may underperform other asset classes. This is the question. That's a very interesting question. So, yes, what we are observing even today is that the dollar is strong. US Treasury 10-year is also at almost 4.6%. And therefore, with this inflation, there is a possibility of a scare of, and with high interest rate, there is a possibility of growth scare may arise, especially in the US. On the European front and Japan, yes, they are already into a very weak economy, and especially Europe is in recession. So, in light of this, at some point we will see U.S. Treasury yield start reversing with the growth scare, and if that happens, yes, there will be an impact on the global economy, and I don't know whether we will get into recession. Especially in India, I don't expect we ever get into recession because of our demography. But yes, there could be a scare of a lower GDP growth rate in light of this global happenings. And at that time, we will have to really look at how it's going to impact the equity. It will impact the equity market, but then at the same time, we still think that there would be few opportunities keep coming, especially on the domestic side. So that would we will have to work hard to figure out those businesses and then put our, I mean, strategize our investment into those areas. But the question is valid, and there is a possibility like that. There's another question is
Most of the questions are related to deployment and our cash position. I think we can.
Abhishek, yeah, you can.
Abhishek, you are on mute.
I'm just checking exactly what is exactly investors want to understand. On the cash side, what is our deployment strategy? Is that
Yes.
so? I think that we broadly addressed this in our view for the market, but see, it will be stock specific and based on how we are seeing opportunities. So we are in the process, and we have already identified some of the businesses which are in the current context interesting. Uh, Either we are looking for better price points for them or better proof or better understanding on some of these businesses. So deployment of cash will be gradual, as even now for most part of the market, we are seeing that valuations are on the higher side in the context of growth that we are seeing. This market will remain volatile as we've been discussing in this call, and you will have phases where suddenly, if there is no bad news, then consequently it's considered to be good news and stocks are being pulled up. But that's a function of number of participants in the market and I think an attempt to make some money. So there will be always a lot of volatility. What we are trying to understand is if the growth remains on the lower side and capital markets are neutralish, if the global trade is also impacted, can we can we invest in few businesses where we expect earnings growth surprise on the higher side and where valuations are reasonable? We are able to look at some businesses. We have few businesses, but investment in them is a process which will take. So we'll take maybe around 3 to 6 months to use the cash as we see things where we stand. But as I just pointed out earlier, we reserve the right to change based on how we see the economic environment and where we find opportunities. If market comes off and there are more opportunities on a bottom-up basis, the cash could be deployed faster. If there is better clarity on the environment, we may deploy cash a little faster. So it's something that we are constantly watching. We are not just because certain stocks have come off, we are not going to deploy to kind of get that 15-20% gain. That's not how we are looking at the investment opportunity.
We have a question from Mr. Sangvi about our view on RBI action of injecting liquidity and what if they cut rates this week? Would that improve the credit growth?
Right. So I think that was a needed step. I think as we just discussed, the RBI has been intervening in the foreign exchange market and they have been selling dollar to keep the dollar from going up significantly against the rupee and buying rupee from the market participants, which essentially means when RBI buys rupee, that money goes out of circulation. So that is one of the reasons why liquidity in the domestic market has been tight. And it was something expected and needed as well. So RBI took a good step of injecting liquidity in the market, rupee liquidity in the market. So that was a needed step. As far as rate cut is concerned, well, we expect RBI to do a rate cut, but I really doubt that they have a lot of room to do that. It's needed and needed to improve the sentiment, but unfortunately, inflation is not really where they can significantly cut interest rates, as well as our currency situation, given where RBI is actually trying to manage, is not such that they can aggressively cut rates. Because if they cut rate, it will put more pressure on the rupee. And as we know, RBI has been trying to protect the rupee and uh, kind of trying to ensure that rupee does not fall to 90 or those levels in a hurry. So to do that, they have been shorting in the non-forward market, sorry, non-deliverable forward market. And as we speak, also they have a $60 billion position in that market. So very clearly, RBI is trying to protect the rupee. With that as the background, it's unlikely that they can significantly cut interest rates. So while it's good for the sentiment, it may not really boost the credit growth significantly. What is needed to drive the credit growth is also the confidence coming back from the private sector. I think we have done a lot of consumption related credit growth over last few years. What we need now is private sector to invest and a credit growth driven by the investment from the private sector. It's a long process of getting that kind of confidence. A lot of factors are affecting it negatively, which is slow down in consumption. We've seen over last few months, automobile numbers have been lower, urban demand has been weak. Also, with geopolitical uncertainty, there is some uncertainty, and private sector may not aggressively invest. However, there are some green shoots. Having said this, there are some green shoots. Rural demand is showing some pickup with this cut in tax rates by the government. There'll be more money in the hands of individuals, which can revive some discretionary spending. And this might, to some extent, bring in some confidence and private sector may start investing. So yes, long answer to your question, but this interest rate alone may not drive the credit growth. You'll need more factors, but it's a good start.
We have a question from Yogesh. He's asking, some market experts have viewed that Indian markets are very high valued compared to other Asian peers, and considering consistent FII outflow, it looked like FII wouldn't come back soon. Are PMs allowed to invest outside India?
So we as a strategy and something that we've been very clear are focused on Indian market, and that's our expertise. That is what we understand. So we are focused on Indian market. Our ability to understand sitting here as to what could be happening in China with Chinese companies or Indonesian companies, understand their policy is very limited. So I don't think we kind of have that kind of skill sets. So we don't intend to do that. So that's one part where we are not really looking to do that. As far as the Indian market is concerned, yes, we've been discussing that in certain pockets there have been valuations which is on the higher side. and also in the context of growth rates. So where India stands out or we've been doing well is that profitability of our companies is good. So our businesses are ROE focused and they've been growing reasonably well. Corporate governance in India is good. Uh, our laws are relatively more predictable. Our courts are something that foreigners can rely on. One of the reasons why we have had high exposure of foreigners in the Indian market. Having said this, our growth rate over last 8-10 months has been going down. Even government is estimating a nominal, as Nilesh Bhai also talked about, nominal GDP growth of around 9.5-10%, which is much lower than what we have seen. So yes, that's one of the reasons why FIIs attractiveness of India for FIIs have reduced. That if India is going to grow at around 6%, 6.5% versus what is expected, which is around 7.5 and 8% for the kind of per capita GDP or stage of growth or demography that we are, this is disappointing. So despite a lot of attractiveness of the businesses here, a lot of good entrepreneurs, etc., the growth rates are disappointing, and one of the reasons why FIs are selling in India. If growth rate comes back with some government policy, with consumption coming back, there is no reason why FIs will not come back to India. But as of now, yes, we don't hold that view. We believe that the selling can continue for the foreseeable future till we see earnings and growth rates coming back.
We have a question from Vikram. Is it right time for new investors to make 100% in equity or need to balance it out with debt for now?
Greatly depend on the individual's risk appetite stage of. So I think best advice would be from their financial advisors, and we are a equity house, and our opinion and where we stand. And given our positioning as of now, we continue to remain a bit cautious and will gradually increase our exposure to equities as and when we find opportunities. So that's what I can say. Your exposure is something that your financial advisor can best advise you based on your risk profile.
I think more or less we have covered our in our thought process on market view and our portfolio strategy, and rest are few stock specific and sector specific which we from compliance angle we don't want to answer these questions. Uh, and I think we have covered everything. So thank you everyone for joining. We will be sharing the recording link very soon, and if you want, you can go through the same again. And if you have any other question, you can reach out to us directly. And thank you so much, and thank you so much again for joining us.